Selling real estate that is not your primary residence. U.S. capital gains tax. When you selling residential real estate that is not your primary residence, such as a vacation home, a rental property, or a fix and flip project, it triggers a distinct set of tax obligations compared to a principal home. While the Internal Revenue Service, IRS, allows individuals to exclude up to $250,000, $500,000 for married couples, of profit from the sale of a primary residence, this Section 121 exclusion generally does not apply to secondary properties. Instead, the entire realized gain is typically subject to taxation, making it essential for sellers to understand the nuances of how these profits are calculated and reported. This financial impact is determined by factors such as the duration of ownership, the property's use, and the seller's overall annual income. The primary mechanism for taxing these sales is the long-term capital gains tax, provided the property was held for more than 1 year. For most taxpayers, long-term rates are significantly lower than ordinary income tax rates, often falling at 15% or 20% depending on one's taxable income level. However, if the property is sold after being held for 1 year or less, the profit is classified as a short-term capital gain, and is taxed at the same rate as your standard salary or wages. Because these rates can climb as high as 37%, the timing of a sale becomes a critical lever in managing the ultimate tax bill. For properties that were used as rentals, the tax situation becomes more complex due to a provision known as depreciation recapture. During the years a property is rented out, the IRS allows owners to deduct a portion of the building's value each year as an expense. However, upon sale, the government recaptures this benefit. This means the portion of the gain attributable to those past depreciation deductions is taxed at a flat rate of 25%, regardless of whether the rest of the profit qualifies for the lower long-term capital gains rates. This specific tax can often surprise landlords who only focused on the headline capital gains percentages. To mitigate the tax hit, sellers must accurately calculate their adjusted cost base, which serves as the starting point for determining profit. The cost base is not simply the original purchase price, it can be increased by including closing costs, legal fees, and the cost of significant capital improvements made over the years. By meticulously documenting renovations, such as a new roof, a kitchen remodel, or a finished basement, a seller can effectively reduce their taxable gain. Conversely, routine maintenance and repairs, like painting or minor leaks, generally cannot be added to the cost base. In addition to federal capital gains taxes, high-income earners may be subject to the net investment income tax. This is a 3.8% surtax applied to the lesser of the net investment income, or the amount by which the modified adjusted gross income exceeds certain thresholds, $200,000 for individuals or $250,000 for married couples. When combined with potential state-level capital gains taxes, which vary significantly from 0% in states like Florida to over 13% in California, the cumulative tax burden on a secondary real estate sale can be substantial. Despite these costs, several strategies exist to defer or reduce the tax liability. A common tool for investors is the Section 1031 exchange, which allows a seller to defer paying capital gains taxes if they reinvest the proceeds into a like-kind investment property within strict time limits. Alternatively, some owners choose to move into their secondary property and establish it as their primary residence for at least 2 years to qualify for a partial Section 121 exclusion later. Navigating these options requires careful planning, and often, the guidance of a tax professional to ensure compliance with evolving IRS regulations. We welcome you to subscribe to our YouTube channel for more informative videos on real estate and investments. Thank you.